Hi friends, so let us continue our revision series of financial management CA intermediate. I've already uploaded introduction, basics of FM and leverages. So if you have missed those videos, I request you to please go and complete those videos before you start this chapter. So today we'll be discussing cost of capital. So cost of capital from exam perspective, a very important chapter. So what do you mean by cost of capital? We know that broadly there are two sources of finance. One is equity, one is debt. If I go inside equity, we have three things. One is equity share capital, preference share capital, and reserves and surplus, correct? So there, if I go in detail, there are four kinds of capital. One is equity share capital, preference share capital, debt, and retained earnings. Now, what I'll do, I'll calculate the individual cost component. So everything in life comes at a cost, nothing comes at free. So when I calculate everything, the cost of individual cost components as well as the total cost of capital, then we'll be completing this chapter. So if I have to calculate capital employed is nothing but equity plus debt or fixed assets plus working capital, that you are already aware. Now, if I come to cost of capital, I need to find out what cost of debt, cost of preference share capital, cost of equity share capital, and cost of retained earnings. We'll go one by one. So how do you calculate cost of debt? First of all, cost of debt is denoted by what? Cost of debt is denoted by KD. Cost of debt is denoted by KD. So none, if I raise money in the form of debt, what will I pay in return? So if I raise money in the form of debt, the other person who is giving me money is anticipating what? He is anticipating interest. Remember, for the entire chapter, what is the logic? Your expectation. Your expectation is the person who is giving you funds, his expectation will be the cost to the company. For example, if a person is giving loan, what is he expecting in return? He is expecting interest. So whatever I pay him back will be my cost. So your expectation is my cost, correct? So what are the situations here? In case of debt, I need to calculate cost of three things: cost of irredeemable debt, cost of redeemable debt, cost of convertible debt, and KD using appropriation method. So these are the four things: cost of irredeemable debt, cost of redeemable debt, cost of convertible debt, and cost of debt using appropriation method. This one, cost of KD using appropriation method, the fourth method which I'm talking about, this we'll study after we learn time value of money. That is after you know how to calculate IRR. So the rest three of the things we'll study in this chapter. Then cost of preference share capital denoted by KP. Denoted by what? KP. So preference dividend. What do we pay for a preference share capital? We pay against preference share capital, we pay preference dividend. So whatever I pay, whatever is the expectation of the other person will become my cost. So I'll be paying him preference dividend. Again, there are two situations: cost of irredeemable preference share capital, cost of redeemable preference share capital. Coming to very important from exam perspective as well as real life is cost of equity share capital, denoted by what? Denoted by KE. So again, there are how many approaches? In total, there are 6 plus 1 derived approach. So first one is DP approach, that is dividend pricing approach. Second one, DP plus G approach, so dividend price plus growth approach. Then EP approach, EP plus G approach. EP means earning price approach. Then realized yield approach. Sixth one is CAPM, capital assets pricing model. And the last one, which is the derived formula for K, that is the reciprocal of P ratio. The last one is cost of retained earnings. Normally, who owns retained earnings of any company? If you turn out the balance sheet, whatever is the reserves and surplus or retained earnings, if you see, who is the ultimate owner of the funds? Equity shareholders, correct? So normally KR equal to KE. Retained earnings is denoted, cost of retained earnings is denoted by KR. So normally KR equal to KE. But if personal tax rate is given or if rotation cost is given, the formula will undergo a slight change. So if I ascertain all these individual cost components of four kinds of finance, then I'll be estimating what? Weighted average cost of capital. WACC is also denoted by KO, and it is also called overall cost of capital. So this is what we'll revise today. We'll go one by one, starting with cost of debt. First one, cost of irredeemable debt. What is the formula? Always remember, notations will change from author to author, but ultimately the formula will remain same. Cost of irredeemable debt. Cost of irredeemable debt in the sense I'll never repay back the debt amount. Whatever debt I have taken, I keep on paying interest. So what is the formula? Formula will always have two sides, the left hand side and the right hand side. So KD equal to interest into 1 minus tax rate, the whole divided by net proceeds of the issue. So what is the formula? Cost of irredeemable debt, KD equal to interest into 1 minus tax rate divided by net proceeds of the issue. So what is to be remembered? Interest is always paid on face value. Remember, interest is always to be paid on face value, not on market value, not on issue price. Interest is always to be paid on face value of your debt. Yes. Now coming to what do you mean by net proceeds? Net proceeds means ultimately what money is coming to my pocket. what money will come to your pocket whenever you issue any securities? There are some flotation costs that needs to be considered. Issue expenses will be there, flotation costs, some transaction costs will be there. So that will not come to my pocket, that will be going away. Yes. And whether the issue is at par, premium or discount. As you are aware, securities can be issued either at par means face value, or at a higher amount, that is premium, or at a discount. Correct? So whatever money is coming to my pocket, that you need to take into your denominator. Correct? So what is the formula? KD equal to interest into 1 minus tax rate divided by net proceeds of the issue. While taking interest, interest is always calculated as a percentage of face value, and net proceeds means everything, net of everything, whether the issue is at par, premium or discount, or net of flotation cost. Flotation cost means transaction cost or issue expenses, what you say. Net of everything what is coming into my pocket, that will be your denominator. Remember, cost of capital is always expressed in what? Percentage per annum. Percentage per annum. So that is how you calculate cost of irredeemable debt. Again, one last time, how do you calculate? KD equal to interest into 1 minus tax rate, the whole divided by net proceeds of the issue. Second one, cost of redeemable debt. Cost of redeemable debt. What do you mean by redeemable debt? Redeemable debt means after a point of time, I'll repay back the debt amount. So that is called redeemable debt. Again, what is the formula? Formula is KD equal to interest into 1 minus tax rate plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. So what is the formula? KD equal to interest into 1 minus tax rate. So this was also there in irredeemable. So whatever was there in the irredeemable formula, same to same copy paste. Because even in case of redeemable debt, I'll be paying interest. Whatever I pay, it is my cost. So interest into 1 minus tax rate, remember, plus interest into 1 minus tax rate plus, what is the formula? RV minus NP divided by N. RV minus NP divided by N. The whole divided by, if you see, the whole divided by RV plus NP divided by 2. Now what is RV? What is NP? RV means redemption value. RV means redemption value. Suppose if I am issuing a debenture today and I'll redeem it after 5 years or after 10 years or whatever the time given in the question, whether I'll be redeeming at par, premium or discount. While at the time of issuing, if I have three options, issue at par, issue at premium or issue at a discount, then at the time of redemption also I have three options: redemption at par, redemption at premium or redemption at a discount. So RV is called redemption value. At what value will I redeem those debentures? Correct? If nothing is given in the question, what is the standard assumption? Issue is also at par and redemption is also at par. If nothing is given in the question. Correct? What do you mean by NP? NP means net proceeds. Net proceeds means if I issue debentures today, what is the amount that I'll get in my pocket? So that was similar to the previous formula. Correct? NP means net proceeds. What is N? N means the term, the life of the debentures. So what is the formula? Cost of redeemable debt, KD equal to interest into 1 minus tax rate plus, remember, plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Where students go wrong, where you have to put plus, you'll put minus. Here RV minus NP divided by N, you'll do it plus. RV plus NP divided by 2, you'll do it RV minus NP divided by 2. And the whole divided by should be there. So this is where you go wrong. So whenever you read the formula, you write the formula, be careful with the BODMAS rules. Yes. So what is the formula? KD equal to interest into 1 minus tax rate plus, understand how I am pronouncing it. KD equal to interest into 1 minus tax rate plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. This is cost of redeemable debt. Coming to the third formula, cost of convertible debt. What do you mean by convertible debt? As the name suggests, at the time of redemption, I'll not just pay him cash. Either I can pay him back in cash or I can issue my equity shares in return. So that is called convertible debt. What is the formula? Formula is as same as above. That means the redeemable formula only will apply. Only this RV value will change. What will change? The RV should be taken at either the conversion value or the redemption value, whichever is higher. So how do you calculate cost of convertible debt? KD equal to, it's the same formula. In place of RV, you should calculate two amounts. One is the conversion value, one is the redemption value. That whichever is higher amount you need to take. Sir, what do you mean by conversion value? Conversion value means after 5 years, against one debenture, how many equity shares are you paying him? So that is called a conversion value. If as a debenture holder, I don't want cash. If I want in exchange equity shares. So against one debenture, how many shares will you pay me? Say for every share I am paying you 10 equity shares. For every debenture I am paying you 10 equity shares. And for each share after 5 years, say the value is 1000 rupees. So what is the conversion value then? Conversion value is 1000 into 10, 10,000. This is how you calculate conversion value. Redemption value is whether the redemption is at par, premium or discount. That will be given in the question. You need to calculate higher of the two. As an investor, which will I choose? As a rational investor, I'll always choose which is more beneficial to me. So either the conversion of value or redemption value, whichever is higher. So this is how you calculate cost of debt. So there are three situations: cost of irredeemable debt, cost of redeemable debt, and cost of convertible debt. Hope this is clear. And you might have observed everywhere we are taking the tax benefit, tax shield impact. As we have seen in the first lecture, first revision class, whenever there is debt, we have a tax shield impact. The higher the amount of debt, higher would be my tax savings. So yes, hope this is clear. We'll go ahead with the preferential capital. So how do you calculate cost of preferential capital? Cost of preferential capital is denoted by KP. It is denoted by KP. Again, there are only two situations: cost of irredeemable preferential capital, cost of redeemable preferential capital. So how do you calculate cost of irredeemable preferential capital? Formula is KP equal to annual preference dividend. KP equal to annual preference dividend divided by net proceeds of the issue. Again, your expectation will be my cost. What is the expectation of a preference shareholder? Obviously, preference dividend. Again, one thing you need to remember: dividend is always, sorry, preference dividend is always paid on what? Dividend is always as a percentage of face value. How interest also as a percentage of face value, like this, even dividend is always as a percentage of face value. Again, net proceeds means net of all the flotation cost. Again, net whether it is issued at par, premium or discount. Exactly similar. What's the difference? There it was interest, here it is dividend. There we have taken tax shield impact because it was debt. Here there is no tax shield impact. Yes. Coming to cost of redeemable preferential capital. Again, what is the formula? Our formula is very simple. KP equal to annual preference dividend plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Exactly as similar to cost of redeemable debt. Yes, there it was interest into 1 minus taxes. Here it is annual preference dividend. Again, RV NP part, it is exactly the same. So how do you calculate cost of redeemable preference share capital? The formula is straightforward. KP equal to annual preference dividend plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Again, RV means redemption value, NP means net proceeds, life means life of preferential capital. Hope these two things are clear, KD and KP. Now we'll proceed ahead with cost of equity share capital. Very, very, very important from exam point of view also, and even from your real life point of view also. From exam point of view, you have couple of formulas, you'll study those formulas, you'll qualify. But in real life, calculation of K is very, very complex and very, very important. First one, DP approach, dividend price approach. In short, we call it as a DP approach, not your WhatsApp DP or Instagram DP. It is dividend pricing approach. What is the formula? K equal to D divided by P. What is D? D means expected dividend. D means expected dividend. D0 or D1. P means MPS, that is market price per share. Sir, when should we take D0? When should we take D1? It depends upon the language given in the question. If in the question directly D1 is given, you need not calculate D1 again. But if you feel the language of the question is in the nature of D0, then you have to calculate D1. So how do you calculate D1? D1 is nothing but D0 plus growth. What is D0? D0 is last paid dividend plus growth. So normally there is some ambiguity from the ICI itself whether you have to take D0 or D1. My suggestion would be understand the language of the question. If from the language of the question it is dividend, next expected dividend is directly given, consider it as D0 and apply that. If the question says the last year dividend was, the company had paid a dividend, so these kind of past languages are given, then you have to convert it into D1. Yes, simple. So how do you calculate DP approach? Simple formula, K equal to D divided by P. Again, you can correlate with this dividend chapter. Just giving you a heads up. Coming to EP approach. Again, very simple formula, earnings price approach. What is the formula? K equal to E divided by P. What do you mean by E? E means EPS. How do you calculate EPS? You have studied basics. In the first revision lecture, it is there. E means earnings per share divided by market price per share. Coming to DP plus G approach. It is an extension of DP approach wherein what is the formula? K equal to D1 by P0. D1 means next expected dividend. P0 means market price today. Against that, we'll put growth. So how do you calculate growth? To calculate growth, there are two ways. One is Gordon's growth approach. The other one is average growth or CAGR. So how do you calculate Gordon's growth? G equal to B into R. G equal to B into R. What do you mean by B? B means retention ratio. How do you calculate retention ratio? 100 minus payout ratio into ROI. ROI, you know what is ROI? EBIT divided by capital employed. So how do you calculate Gordon's growth? G equal to B into R. The other way to calculate G is what? Your CAGR formula. You might have studied in CA foundation. What is the formula? Dn divided by D0 to the power 1 by n minus 1. G equal to dn divided by D0 to the power 1 by n minus 1. How do we remember this from class perspective? What is the value today divided by what was the value then to the power 1 by n minus 1? What is the value today divided by what was the value then to the power 1 by n minus 1. So in dp plus g, what is growing? See, in dp plus g also there is g, in ep plus g also there is g. What is the difference between this g and that g? This g, in dp plus g, whatever g you are seeing here, this is growth rate in dividend. And in ep plus g also you have a g. What is that g? That g is growth in earnings. Understanding the difference? dp plus g में जो g है that is growth rate in dividend. ep plus g में जो g है that is growth rate in earnings. Correct? So how do you calculate g? Again, to Gordon's growth approach, CAGR. Gordon's formula B into R, and average growth, that CAGR formula dn divided by d0 to the power 1 by n minus 1. So coming to EP plus G approach. Again, very simple. K equal to E1 divided by P0 to the power plus G. So what is G? G is growth in earnings. This time this is growth in earnings. Previously the G was growth in dividend. Yes. Coming to very important. Mark this as very important. CAPM. So what is the formula? CAPM equal to KE equal to RF plus, stress on my language, RF plus RM minus RF into beta. So how do you calculate CAPM? K equal to RF plus RM minus RF into beta. Sir, what do you mean by RF? RF means risk-free rate of return. Risk-free rate of return bole to, if I go and invest my money in a post office or in a government securities, what is the minimum return that I can get? So that is called risk-free rate of return. That is the minimum return that I can earn without taking any risk, zero risk. So for in my example, I'll assume it as 4%. So what is RF? RF is the minimum required return. If I don't take any risk also, if I go and invest in government securities also, boss, I'll get 4%. Now coming to what is RM? RM means market rate of return. What do you mean by RM? What is the average stock market rate of return? Yes, what is the average stock market rate of return? In real life, the calculations are different. You'll study it in CA finals. However, from exam point of view, it will be given. Now I'll say market rate of return is 10%. Market rate of return is 10%, correct? Now, where there is more risk? In government securities, there is a risk, or in market, there is a risk. Obviously, share market is risky. I'm taking that risk. I'm taking that risk. And you have studied in the thumb rule of FM, higher risk, higher returns. Only because I'm taking risk, I'm not putting my money in government securities. I'm coming and investing that money in market, share market. I'm earning how much extra? 6%. Yes, this 6%, RM minus RF, RM minus RF. This is called what? Risk premium. What do you mean by risk premium? RM minus RF. So the excess returns earned over and above the government securities only because you went and invested in the market. That is called risk premium. Terminology is important. Examiner will test you here. So what do you mean by risk premium? RM minus RF. This entire bracket. What have I highlighted, underlined in red? RM minus RF. Yes, into beta. Now you'll ask me what is beta? Beta is an instrument to measure risk. Which risk? The risk that arises due to fluctuations in the share price. Since this is a revision lecture, I'll just touch and go. What do you mean by beta? Beta means if market falls by 10%, if market falls by 10%, by what percentage will a particular company's share price fall? I repeat, if market falls by 10%, whether Tata Motors share price will also drop by 10%, or it will drop by 20%, or it will drop by only 2%, or it may be constant. So this is called beta. What is beta? Beta is an instrument to measure risk. Which risk? That risk which arises because of fluctuations in the share price. If market falls by 10%, whether the company share price is also falling by 10%, or it will fall by double, or if the market goes up by 10%, whether Tata Motors will go up by 10% or it will go up by 20%. So that is measured by beta. In CA final calculation is there altogether a heavy discussion, but from CA inter point of view, beta will be given in the question. So what is beta? Beta is an instrument to measure risk. Which risk? That risk which arises because of fluctuations in the share price. Now you have to multiply your risk premium with your beta. You have to multiply your risk premium with your beta, and then you need to add RF. So what is the formula for CAPM? K equal to RF plus RM minus RF into beta. Again, what do you mean by risk premium? Risk premium means RM minus RF. Yes. So beta for stock market beta generally it is considered as 1. Stock market beta generally it is considered as 1. Yes. So if my beta is more than 1, say if my beta is say 2 times, if my beta is 2 times, it means what? If market raises by 10%, my company share price will raise by 20%, 10 into 2, 2 times. If market falls by 10%, my company share price will fall by 20%. Understanding the point? What is the importance of beta? If beta is 2, market raises by 10%, my company will raise by 10 into 20%. The same is applicable vice versa also. If market falls by 10% and my company's beta is 2, it means my company share price will fall by 20%. Again, thumb rule, high risk, high returns. Higher the beta, higher would be the risk and also higher would be the returns. Yes. And what is the expectation of equity shareholder? If he's taking more risk, he wants more returns and his expectation will be my cost. Yes. Coming to realized yield approach. Again, realized yield approach, it requires the prior knowledge of time value of money. This will do after capital budgeting, that is after IRR. Yes, coming to cost of retained earnings. So as discussed, who is the ultimate owner of this retained earnings? It is the equity shareholder. Rather than taking it home, he is keeping his money in the company's balance sheet, company's bank account. So normally KR equal to KU. What is the normal cost of retained earnings? Normally KR equal to KU. But if personal income tax rate is given in the question, if the personal income tax rate of the shareholder is given in the question, in that case, KR equal to KE into 1 minus PTR. PTR means personal tax rate. PTR means personal tax rate. Yes, not the company's tax rate, personal tax rate. So if personal income tax, normally what is the formula for KR? KR equal to KE. But if personal income tax rate is given, then KR equal to KE into 1 minus personal tax rate. If flotation cost is also given, then normally KR equal to KE. But if flotation cost is given, then KR equal to KE into 1 minus flotation cost. 1 minus flotation cost. Sir, in the question, both personal tax rate is also given, flotation cost is also given. Then very simple. KR equal to KE into 1 minus personal tax rate into 1 minus flotation cost. This is how you calculate KR. Okay. So you know the individual cost component KD, KP, KR, KE. Yes, you understood everything. So then how do you calculate weighted average cost of capital, also called as what? KO. Weighted average cost of capital, also called as KO. So what I'll do, I've just drawn up a table here. So there are 4 sources of finance: equity share capital, preference share capital, debt and reserves. Now assume I needed 100 lakhs, 100 crores. I needed capital of 100 crores. I raised 50 crores by equity, 30 crores by preference share capital, 10 crores by debt and 10 crores by reserves. So this is my capital structure. We'll see in the next chapter. I've just assumed the figures. Now I've taken the proportion. How do you calculate proportion? 50 divided by 100, 0.5, 30 divided by 100, 0.3, 10 divided by 100, 0.1, 10 divided by 100, 0.1, and this total should always be 1. So I have taken the values, I have taken the proportion. Then cost of capital. Cost of capital means individual cost component. That is nothing but your KE, KP, KD, KR, the individual cost component which you just studied. So I have taken these figures, arbitrary figures. Now what did I do? I multiplied the proportion into cost. I multiplied this proportion, this column into this column individually. So 0.5 into 0.12, 0.3 into 0.10, 0.1 into 0.08, 0.1 into 0.012. So proportion into cost, proportion into cost, proportion into cost, proportion into cost. I've taken the proportion and then I've taken the total of this. And when I take the total, when I convert it into percentage, this is called WACC, WAC, also called as KO, also called as weighted average cost of capital. So how do you calculate weighted average cost of capital? Proportion into cost, proportion into cost, proportion into cost, proportion into cost. So proportion, you need to take value. Then individual cost component, you know how to calculate, you have studied just now. So proportion into cost, proportion into cost, proportion into cost, proportion into cost will give you WACC. Proportion into cost, you need to take the total and then the total of this column, where the total of this column will give you WACC. So this is how you calculate a full-fledged weighted average cost of capital. Again, now I have taken some value now here, the figures. Now to take this, to calculate WACC, there are 2 approaches. Either I can use book value as weights or I can use market value as weights. Now when I needed this 100 crores, I have taken 50 as a book value. I have taken 50, 30, 10, 10 as a book value. What is the difference, sir? When I calculate WACC using book value as weights as against when I calculate WACC as market value as weights. So what the difference is, when I have taken book value as weights, reserves or retained earnings is also shown as a separate cost component. I repeat, when I have taken book value as weights, reserves will also be treated as a separate source of finance and it will be considered for WACC calculation. However, when I take market value as weights, then reserves and surplus is not treated as a separate component of finance. When I take market value as weights, reserves is not at all taken as a separate component of finance. This is the difference. When I take book value as weights, when I take market value as weights, the difference is the reserves and surplus. Whenever I take book value as weights, retained earnings is considered as a separate cost component. Whereas when I take market value as weights, reserves is not taken as a separate cost component. Why? Because whatever value addition my reserves is creating, you tell me by common sense, the company which has higher reserves, the market price of that particular company, the market price of equity shares of that particular company will be higher or lower? Obviously higher. So whatever is the value addition given by your reserves is already reflecting in where? It is already reflecting in the market price of equity shares. I repeat, why reserves is not considered while taking market value as weights in WCC calculation is because when I take market value, market price, market value as weights, whatever is the value addition, whatever is the value addition created by your retained earnings, your reserves, it already reflected where? It is already reflected in the market value of your equity shares. Because of this reason, I'll not consider reserves as a separate cost of component. Yes, what is the takeaway? How do you revise? For WACC calculation, there are two approaches: book value as weights and market value as weights. What is the difference? If I take book value as weights, then retained earnings is considered as a separate component of finance. Whereas when I consider market value as weights, then reserves will not be considered as a separate component of finance. So in the question, both book value also will be given, market value will also be given. They'll ask you to calculate WCC two times. So what is the approach that you need to take? In one approach, when you're taking WCC using book value as weights, you need to take retained earnings as a separate source of finance. But when you're doing it as market value as weights, you need to ignore the retained earnings as a component of finance. So this is the difference. Coming to last concept from this chapter is marginal cost of capital. What is the marginal cost of capital? The cost of raising additional funds. That is called marginal cost of capital. Normally, as we have discussed, additional funds will always come at a additional cost. Why? Already there is a debt provider. If you want more debt, the other person, the second person who is giving you debt is taking more risk. So his expectation will be higher than the first person. Likewise, already there are equity shareholders. If you want to raise more equity, the second person who is giving you money is taking more risk on you. So his expectation will be more. So normally the marginal cost of capital will be higher than the original cost of capital. So how do you calculate marginal cost of capital? It is the same approach as we discussed in WACC. So this is all about a very, very important chapter named cost of capital. So if you don't revise cost of capital, if you don't do cost of capital, the corresponding next chapter, that is capital structure, that you'll not be able to do. So cost of capital and capital structure both are interrelated, interconnected. Only if you know cost of capital, you can do capital structure. So revise this immediately after watching this video. Take up your question bank, solve each and every question, make your summary notes like how I have made. I've already told you in class. Make the summary notes, and next time when you revise, only your summary notes plus questions. So this is how you need to take a approach. Yes, that's all for this video. We'll again meet for the next video with capital structure. Yeah, thank you.